If you're a realtor, homeowner, or someone looking to refinance your house and you're trying to make sense of what this Federal Reserve 50 basis point rate cut means, you need to watch this video. For those of you who don't know me, my name is Aaron Gallagher. I'm a mortgage broker with Edge Home Finance, and I want to become your number one mortgage guy. So the Federal Reserve cut interest rates. Now what? What most people don't seem to realize is that the Federal Reserve controls interest rates on things like car loans, personal loans, credit cards, student loans, and business loans, for example. But mortgage loans are driven by what are called mortgage backed securities. Mortgage backed securities are traded on the open market, kind of like a stock or a bond. People buy them and people sell them. Now, the chart I have down here below is called a Japanese candlestick chart. And this chart represents the price fluctuations of mortgage backed securities. So this chart goes all the way back to 2018. So you can see that back in April of 2019, for example, where my cursor is, mortgage bonds pricing was higher than mortgage bond pricing is today. And that's going to be important here in a minute. Now, mortgage bond pricing, here's how it affects mortgage interest rates. When mortgage bond prices are high, meaning mortgage bonds are in demand, investors want them, the price of the bond goes up, mortgage interest rates go down. And that's representative of this big spike in price in mortgage bonds. And this was in April of 2021. This is when we saw 30-year fixed rates drop to the lowest point anyone had ever seen them. And the refinance activity was absolutely crazy at that time. And as you can see since then, mortgage bond prices have been on a roller coaster ride on the down slope. So as the bond prices have fallen, the mortgage interest rates have went up. Now, Aaron, why did mortgage interest rates go up? Why did these bond prices fall? How come bonds, mortgage bonds specifically, fell out of favor with investors? Well, there's one word for that: inflation. Inflation is the enemy of a fixed rate return investment like a bond. And when investors see that their dollar doesn't buy as much, that 5% interest today isn't the equivalent of 5% interest tomorrow because the dollar buys less. So they said, forget it. We don't want these bonds. We'll stick our money somewhere else. Some have been sitting in cash. Some has went to precious metals. Some has went back into the stock market. But bond prices just fell off a cliff. And at one point in time, we even touched 8% on a 30-year fixed rate mortgage, which is absolutely crazy if you're thinking about the historical interest rate environment we've had, say, since 2000. 8% is really not that whacked out if you look at it on a much longer timeline, but everybody thinks, oh my gosh, it's the end of the world. It's 8% in rates. That being said, there's a brief rundown of how mortgage bond pricing and interest rates work. As you can see here today, we've been on a roller coaster ride, but this time the roller coaster ups and downs are on the upward trajectory, which is good news for us. Now, as you can see, mortgage bond prices are still less than they were back here. So we've still got some room to go, but we are finally back down into what I would consider a normal interest rate environment, historically speaking, over the last 20 years. Now, people have become so accustomed to the artificially lowered rates during the crazy times, 2019, 20, and 21. But now that things have settled back down and getting back to relative norm, so have interest rates. Now, that being said, what is the future outlook for interest rates or mortgage interest rates? Now, this is just my opinion. You're going to hear lots of different opinions about this. Some people are far more qualified than me to speak on it. We're in an election year, and you've got one candidate who says this, and you've got one candidate who says that. I'm not going to turn this into a political discussion. I'm going to talk in generalities. One candidate thinks the role of government involvement in the average day-to-day life of taxpaying citizens should be more. And one candidate thinks that the government's role in the taxpayer's life should be less. One candidate we would perceive as pro-business, one candidate we might perceive as pro-government. If we get the pro-government candidate into office, then we might see inflation continue to rise as government spending still spirals out of control, therefore causing more inflation. And again, as said previously, inflation is the enemy of bonds, mortgage bonds specifically, and treasury notes and T-bills and things like that too. If we get the more business candidate in office and we start to see inflation moderate, that's going to be a favorable environment for mortgage bonds. And as we see investors start to come back into those bonds, driving the prices up, we'll start to drive those rates back down again. And that would lead to a more favorable environment for bonds because
It's
inflation
9
is
o'clock.
moderated, therefore making it more appealing to investors to come back in and buy the bonds, driving up the price. and then driving down the rate again. And I think if we saw interest rates on a 30-year fixed rate between 5 and 6%, that's very healthy. I think that's an interest rate that allows for more home ownership because it doesn't increase the monthly expense of the house payment because interest rates are at 7.5 and 8 or 6 3/4 or whatever it is. Now, I've got one caveat to that. The United States housing stock is anywhere between 4 and 6 million homes short, depending on who you listen to. And what that means is we've got so much pent up demand for home buying that if we could wave a magic wand over the next 2 3 4 years and build 4 to 6 million homes, we would be able to sell those homes because people are looking to move on in life, get out of apartments, upgrade homes, things like that. But that's just not going to happen. It took us a long time to create that deficit or that hole, and it's going to take us a long time to backfill it as well. So even though we're going to start to see interest rates come down because inflation is going to moderate, we're still going to be lacking on housing. So it's still going to be a challenging market out there, no matter what anybody says, in my humble opinion. All right, so the Fed made that 50 basis point rate cut. What did that mean to mortgage interest rates? Well, it didn't mean much. As a matter of fact, the same day that the Fed made that cut, my interest rates went up a little bit, as did almost everybody in the mortgage business. And you're saying, Aaron, how can that be? Well, the perceived cut was already baked into the current rates. So 2 3 4 weeks ago, the bond market figured, hey, based on the way things are going, the Fed's going to cut 50 basis points. That activity or that decision had already been baked into rates. Investors had made their decisions. We did see rates come down a little bit because of it. And that's why there wasn't some immediate reaction in the bond market that lowered interest rates. The 50 basis points or half a point that the news leads everyone to believe. It really makes my phone ring off the hook when people call and say, hey, they just cut it half a point. Where's my new rate? It just doesn't work that way. And the news doesn't do a very good job of explaining to consumers how that works. All right, so let's take a look today at what the 30-year fixed rate is for a well qualified customer in Illinois, according to Google. These aren't my rates. This is what Google is saying is a national average on a $300,000 loan with 20% down in the state of Illinois, which is my backyard, with a fairly well qualified customer between 700 and 719. They're saying 6.926%. Now, I'm going somewhere here with analysis here when we go through these next few tabs. So if we look at Quicken Loans on their 30-year fixed rate, they're better than what Google is saying. But if you look down below, an interest rate of 6.5 with an APR of 6.797 also cost the consumer 1.875 in points, meaning the consumer is having to pay an extra $5,156.25 for the privilege of getting that rate. So that's what points are. I'm not saying points are good or bad. Some loans we charge points on, some we don't. Just depends on the consumer's needs. But most people say, well, gosh, I'm going to go to Quicken over what Google said because they're 6.5. Well, Google didn't disclose whether or not there were any points involved. Quicken Loans is saying there's some points involved. If we go over here to Wells Fargo on their 30-year fixed rate, oh my goodness, they're the best rate out there at 5.625. I mean, look at that. But if you go down and look, there are points being paid as well. Closing costs include the cost for required discount points. And those discount points are what people are paying in order to that interest rate that's being quoted. And it says today's purchase rates are based on the purchase of a single family primary residence in Texas. This rate assumes a credit score of 740 and includes one discount point. So they're paying a point in order to get that rate. And that's why when we talk about interest rates, you might feel that you have to go with the lowest rate quoted by the banker or the commercial or the web. But you really have to dig deep to see what that comes along with, because my no points rate might be better for you than the rate being quoted from Quicken Loan with points, or we might have to match Quicken's points or be better on points. But my point being that you have to read the fine print in order to determine what the cost of money is to you. Okay, so keep that in mind. And as a mortgage broker, I have over 100 lenders I can go to. So if there's a product out there that fits your needs and you qualify, I can definitely find it for you. And in terms of interest rates, I'm always competitive. Most of the time, I win because I hate to lose. But when it comes to going up against banks, we really do a good job of beating them just because we have so much more at our disposal. So I hope this basic explanation of the Fed rate cut made sense, and that you understand that mortgage interest rates just aren't going to go down a half a point overnight because of that, but we are trending in the right direction. Now, if you have any questions or want to have a one-on-one consultation with me, please don't hesitate to reach out to me. My telephone number is 217 618 6811. I'll also have it down below in the video here. And you can always email me at aaron.gallagher at number1mortgageguy.com. That'll be listed down here below as well. And if you've already got a deal in play and if you want to see if you're getting a good deal or not, just give me the loan estimate. Let's get on the phone together or a Zoom call and we'll go through it line by line. If you're getting a great deal, I'll tell you, you got a great deal. Stick with your lender. Or if there's a way that I can improve the situation and beat that lender to give you a better deal, I sure would love the opportunity to do so. Again, Aaron Gallagher, I want to become your number one mortgage guy. I'm a broker with Edge Home Finance. Thanks for watching and have a great day.